Hello everyone, welcome to Finance Wisdom. In this video, we're going to talk about ways to achieve financial flexibility. If you're new to this channel, do like and subscribe to the channel. In order to achieve financial independence faster and with a higher standard of living, there is a method that allows you to increase your income without having to spend any more money in the present. Right, you'd probably say that it seemed too good to be true. And to be honest, that's exactly how I felt before I started looking into it this week. But looking at the historical data we have, it actually does seem possible with a few tweaks if we embrace what may just be the most underrated key to our financial success, which is the ability to make smart decisions. If you haven't done so already, please like this video and subscribe with alerts on for more money-related videos like this one every week. And if you want to further support the channel, you may check out some of the links I've provided in the description below. Financial flexibility is the ability to shift your spending levels up or down at any given time, depending on the situation you're in. So when I say financial flexibility, what I mean is the ability to shift your spending levels up or down, depending on the situation you're in. The more you can shift your level of spending, the faster you can complete that shift and the longer you can hold that new level of spending. Being able to drastically reduce your spending for lengthy periods of time will greatly reduce your stress levels when it comes to financial concerns if you're able to do so. The fact that losing a job, seeing investments fall in value, or getting an unexpected bill still sucks doesn't mean that you won't be able to recover from them faster and more reliably. But it does make your response to those events clearer, and as a result, you're more likely to be able to recover from them more quickly and more consistently. Financial decisions may begin to shift in your favor when you begin to see the long-term growth potential in your investments as more important than the short-term fluctuations in your portfolio's value. While we can and should look to other ideas to get ourselves started, it will ultimately come down to experimentation and keeping an open mind over time. We will slowly find more and more cost-effective things to see, have, and do, which we can use to replace our other high-cost activities so that we can gain financial security. There is no one who truly enjoys making interest payments, even if they enjoy the thing they got into debt for. But that does not change the fact that debt itself is a barrier to our ability to be more financially flexible, and it can be easily cut without significant negative impacts on our lifestyle satisfaction. As an example of the benefits of becoming more financially flexible, let's say Dave has a $2 million nest egg and is ready to take the plunge toward financial independence. Dave isn't the most financially flexible person, and as a result, he tends to be cautious when it comes to investing. Instead, Dave prioritizes saving. In the previous videos, we have seen that the permanent portfolio does a reasonable job of protecting one's asset during economic downturns, but its long-term growth potential is not as great as it could be. I should note that since making those videos, I've updated the return figures to include data from all of 2021. But as some of the historical returns are estimates, since we don't actually have actual index funds to invest in, I'll be using a slightly different set of numbers today. But based on the existing data and our best projections, the portfolio would have maintained a minimum 30-year safe withdrawal rate of roughly 3.14 since 1927 based on the information we presently have available to us. For every possible year between 1927 and 1991, if we assume that we adjusted our income to keep up with inflation each year, the permanent portfolio would have generated about $95,775 on a $1 million nest egg. It's true that the average minimum income was higher than the expected minimum safe withdrawal rate of $31,000. But keep in mind that this was the worst case scenario, and most years didn't have to start off that low to make it through a full 30-year cycle with cash to spare. The average maximum income was $48,500 on average for each cycle. So let's say that through his life of experimentation, Dave has discovered how to live quite happily for extended periods of time on the equivalent of $24,000 a year. He doesn't normally live this way, but in the event of an economic meltdown or emergency, how much would these figures change him to still enjoy life? What do you think? In years when his investments are valued at least 10% below all-time highs, let's say Dave will reduce his spending to $24,000 annually, adjusted for inflation, in order to avoid depleting his nest eggs too quickly. Once his investments have returned to within 10% of their all-time highs, he will resume his normal spending habits. This isn't a huge increase, but it's still an improvement over his previous yearly salary of approximately $95,000. Median income is stable. However, the lowest and highest incomes differ significantly. The minimum figure drops to around $36,000, while the maximum rises to more than $118,000, which is due to the fact that John intentionally lived on less during down markets, which allowed his nest egg to recover back to baseline faster, and judging by the average income figures, it was a net positive strategy. On average, Dave would have needed 51 years to reach if his savings rate was 50%. However, if he had a more flexible budget and a higher safe withdrawal rate at 70, he could have done so in just 16 years. He would have reached his goals in 77 and 90 years, respectively, if his savings rates were 50 and 70%. However, he could have done so twice as quickly if his savings rates were 30%. However, it would have taken him a long time too if he had a more flexible budget. His withdrawal rate would be closer to 4.3% since, unlike the permanent portfolio, we really have a significant number of years when the S&P 500 was down by at least 20%, resulting in a higher withdrawal rate of roughly 3.45%. The ability of an investment strategy to increase its safe withdrawal rates and financial independence income metrics when using optimization techniques such as flexible budgets is what I refer to as the strategy scalability, and there can be a big difference between strategies, especially if you start stacking multiple optimizing techniques. Returning to the numbers, even if the first 5 years of financial independence, Dave's average median minimum and maximum income rise to $130,400, $128,800, $36,700, and $247,300 a year, respectively. His ability to acquire financial independence is likewise increasing in frequency and speed. It takes him 54, 30, and 18 years on average to save 15%, 30%, 30%, 8%, and 9% of his income at each level of saving compared to the 44 and 13-year averages we saw from the permanent portfolio using a flexible portfolio. Of course, a flexible budget is one of them, but it's far from the only one. What if we combine the flexible budget with other strategies? Then we're talking about some pretty extraordinary territory. For example, many people choose to have a little extra cash on hand beyond their investments and even their emergency fund before taking the plunge into financial independence with the idea that if the markets hit a couple of rough years. Dave's minimum safe withdrawal rate would be 4.44 if you put that money in a high-yield savings account or something similar and earned 0.5% interest on it. When you first become financially independent, you set a safe withdrawal rate such as 5%. Financial guardrails keep your income from rising to a point where you're at risk of running out of money. But they also keep it from falling to a point where you're unable to put food on the table. This is done by checking to see if your projected income is higher or lower than the safe withdrawal rate you set at the start of financial independence. If your projected income for the year was higher or lower than 6% or 4% of your remaining nest egg, you would adjust that projection by a predetermined amount, say 10%, to bring it back within the guardrails or at least get closer for this video. We'll say that Dave's guardrails will be 20% above or below whatever his initial safe withdrawal rate is, and his adjustment will be 10% of his projected income for the year. $66,400, $99,600, $36,700 and $155,300 in total are the average median minimum and maximum income figures that David would have reached financial independence using the previous savings rates in 668,592 and 96 of all scenarios. Thank you for watching. I hope you have learned something from this video. If you like this video, do give us a like, subscribe to the channel, and comment down below. If you would like to support our channel, you can click on the subscribe button below, as this will motivate us to do better. Thank you and goodbye.